Good morning, everybody, and welcome to my daily plan. And I got to the office 2 minutes early today, but there's nobody here, which is okay. It's Black Friday. Anyway, I'm just gonna look at this chart and point out that this chart isn't moving, and our E-mini chart isn't moving, and I imagine most of you know why. Let's see. I got another 40 seconds or so before I. Good morning, Selena. Okay. People are starting to come in, and I'm not going to officially start saying anything before everybody gets here. But it's going to be an interesting day with what we know. We know the E-mini's not trading, and we don't know when it's going to start and how that's going to all unfold. But we do have a reference point with SPY. Okay, it's now, looking at my clock here, it's now 8:30, so it's officially time to start. I'm going to get my handsome face off the screen, and so I can turn to my other 8 monitors and see what's going on. Okay, so I'm sure some of you might notice that SPX isn't moving and that E-mini isn't moving. And in case the first thing on Black Friday morning after Thanksgiving weekend, in case for some crazy reason you didn't check your Twitter feed when you woke up with a food hangover, let me enlighten you as to what's going on. So what's going on is this. The CME, Chicago Board of Mercantile Exchange, which is where all this stuff trades. Why is this not showing pre-market? This is setting session. How do I do this? Oh, extend it out. There we go. That's what I wanted to see. Okay. The CME, which is where all this stuff trades, went down. Cooling Center, CyrusOne. Some of you remember CONE. It was taken over by KKR. I used to own it. Data centers were a good play in the late teens, 2018, 19, 20. CyrusOne was a good one. DLR, Digital Realty, also some of the adjacent cell tower trades. All those were interesting trades back then, a lot of moving parts. Cone, CONE, was taken over by KKR. There were talks of other people taking it over. So anyway, that's who owns it. So I don't know if KKR stock is getting hit. Let me get back to where we are. So there's no reference point to trade off of for the SPX other than SPY. Remember, SPX is it's not really a thing. It's something that tracks the index, and E-mini is the closest thing to what it actually trades off of, and the E-mini trades off of the underlying constituents of the S&P 500, i.e. Apple, Nvidia, Amazon, Exxon, et cetera, et cetera. And so we have to use SPY as a reference point to see what's going on. And we'll beg the question for a minute and circle back to it to so how market makers are hedging this. Right? SPY has movement because that's an ETF and that's independent of the CME. So that's going to have movement. So that's the best thing we have. The question is, how are market makers hedging this movement? And the answer is, no one really knows. From what I hear through the grapevine, they're hedging it with SPY. They're hedging it with swaps of some sort, whatever that means, like interbroker. I don't even know what that means, like amongst themselves. Luckily, it's a thin liquidity overnight session and a thin liquidity holiday weekend and a thin liquidity Black Friday. And so it's not like the FOMC is today or non-farm payrolls is today and everybody's scrambling to do something. Nobody really gives a rat's ass. So there's really not a lot of independent movement. Okay. Okay. What's the US 500? Is that the ticker I would find in? Well, actually, hold on. Before I do that, and we'll get back to playing this game in a minute. Let me just do this. Okay, so here's something in TradingView that approximates SPY SPX levels. And so basically we're up from the close. We're roughly 60, 68.30. Now it looks like we want to go higher. So that's what we know. There you go. That's my girl. Quickly, my favorite person. Oh, I see a little shoot on ES. They got it fixed before the market opened. Okay. Well, now I don't need SPX over here, but look how that's wrong anyway. Okay, so it's a piece of junk. Okay, so here we are. And I don't know why I labeled this EM Center. That's what I know it should be labeled. But anyway, that was EM Center when I took it based on the close. EM Center really for this is about 20. So what do we have going on here? I think I have it somewhere else, so I can just do it here. Where's my clever thing? There we go. Well, no, okay, that's not the accurate one. I gotta go with this one. Where is it? Where's the one I was just showing you guys? Discuss amongst yourselves while I get my shit together. This isn't it. Was this it? Here it is. Okay. Okay, so here we are. So the IC whale got skewered on, got harpooned, better word, on Friday. For those of you that don't know who the IC whale is, the IC whale has a trading service, a signal service. He tells his minions, buy or sell these iron condors, whatever it is. It's a big service. He charges a lot of money. And so it ends up, they've ended up going as high as 64,000 contracts, like more than JP Morgan does on their column. So it gets pretty big. He also has a small hedge fund, but it's not that much liquidity because it's only 5 wide. But still, it's big and it matters. I think he had 3 losses in a row last week, so this is his 4th loss. So the sizes are pretty big. And we'll look at the sizes and where he is. I didn't label this good at all. I must have been. So let's just do this here. Indulge me, folks. We got one. We got the call spread up here at 40. Isn't that cute? Now we got the put credit spread. Okay, I got the put credit spread here. I just don't have the call for whatever reason. Okay. That's where the IC whale is. And how many contracts are there? There's, I think this is wrong. I would think there's more. It says there's only 10,000. Let's look at depth view to get like a clear view of the numbers. And maybe because there's something already there. No, 10. 10,000. Okay, 10,000 it is. So that's big, but it's not crazy big. 10,000 could be overrun a lot easier than 30,000. And it's 5 wide. So it could be overrun on either side. Not predicting that it will. Just let's factor it in. So we have a few interesting things going on. We have the 6,800 round number, and not surprisingly, there's interest there. It looked to me like there was a put credit spread at 58, 6810, 6,800 that traded on Wednesday, kind of midday, late day, as we were up near the highs actually. So, and we'll look more granularly to see what's going on. Let me just give you the landmarks. So 6,800, obviously. The expected move when I looked before was 25 when we were at the equivalent of 58.20 SPY-ish, best I could guesstimate. Now let's take a look. Now that we have E-mini trading, it would have been nice to have the hyperbole to get all crazy about, but we don't. Okay. This is obviously a wrong number. I don't think I'm up $27,000 on 4 iron condors, but wish I could get that. All right, 26. Okay, so it really hasn't changed in the overnight session. That sounds like a lot for half a day. With a VIX of 17, if we're going to go with VIX 17, it's it had IV 37. That's crazy. If we go with the VIX of 17, a VIX of 16 would be a 1% expected move, would be 30 points on each. Yeah, maybe it could be. Maybe that might be right. That might be right-ish. That might be right-ish. Okay. So that's what's going on there. That's what's going on there. All right. So let's get back to the chart. Let me just talk about the other things that are going on. These are things not just to remember for today, but to remember going forward, I think. So at 68, 67.55, 67.55, 67.50, 67.45, all in here, we have a bunch of stuff. We have the JP Morgan collar, the call, the sold call that was sold 3 months ago, which is now in the money, support, quote unquote, which was resistance and support when we were over and under it. And when we were at 6,600, when we were at the bottom a week or two ago, I was telling people, we're going to end up there or higher. We're ending up there. And I thought I was crazy. Apparently, I'm not. And that's where we end up. And the JP Morgan collar for December is 7,000. And we're going to end up there. And I've been saying that for months too. And that's where we end up, is just the way it is. It just happens to be the nature of the trading universe. Not that they make it happen, but that's the way the hedging just kind of turns out. Okay, so JP Morgan has a JP Morgan collar here. It's small, quote unquote, only about 8,000 contracts. But 8,000 contracts matter, 0 DT, especially we know they're not being traded. Nobody's closing them. They put it on and they leave it. They don't trade it, they don't manipulate it, they don't take profits on one leg or another if they're profitable. It's a collar, a standard institutional trade. Look it up. In Investopedia, what a collar is. A collar is you buy, technically a collar is you would be buying a put and a call. You'd be buying a put and selling a call to lock in a hedge. The way JP Morgan does it, might as well do the little explanation since there's not a lot going on today. The way JP Morgan does it is they buy a debit spread. It starts off with a debit spread. They buy a debit spread 3 months out, the end of the month, so that'd be February. Let's play the JP Morgan game. So they're going to go to well, we can't because the numbers are crazy, but we can just look and we can play the game later. So they're going to be buying they're going to be buying a debit spread for February EOM, 91 days from now, 5% out of the money. So where's 5% out of the money? Break out our trusty calculator. Now let's just say we're at 67.25-ish, right? Times 0.95. So they're going to be buying a 63, 50, 40. They're going to be buying a put somewhere in here. 63, what is that? 6388. 6,400, let's call it. So they're going to be buying a put somewhere around here. You know, they actually like do the arithmetic and do it right. They just don't make shit up like I do. I'm going to approximate. And it ends up being about $20. They end up buying a put near here somewhere. They're buying it, not selling it. And they further finance that debit spread. We use 67.25 as a reference, right? Wait, that I think I might have used the wrong reference. It should be 68.25, right? Times 0.95. 64.83. There we go. Now, okay, that's where we are. 64.83. Let's call it 64.75 just for fun. And then they're going to be selling against that 68.25 times 0.8, 20% out of the money, of 54.60. Let's make it 54.50, just so we can have numbers that are easier to look at. 54.50. So that's what they're going to be paying 80-90 for that, ish. Okay, so that's what starts the process. What do we got to pay for the insurance? We don't want our big money people to lose more than 5%, and we're protected down to 20%. If we're down more than 20% from here and now in 3 months, well, then that's their problem. It's basically the idea. And so what are we going to sell to finance it? We typically end up about 3% out of the money, but that's not what makes the decision. What makes the decision is what this costs. And where does that put us? Lo and behold, that puts us at around 71.50. Sounds good to me. So February 71.50, write it down, folks. That's where we're going to be, give or take. 7,100, 71.50, somewhere in there. That's what they're going to sell. And this is going to be the structure. Now, it's small. It's only 8,000 contracts. This is the Baby Bear Fund. They have 3 ones. The big one is the quarterly. Then they have the Papa Bear, which is about 12,000. That's a Papa Bear, excuse me. Then they have the Mama Bear, which is about 12,000. And they have the Baby Bear, this one, which is around 6 or 8, whatever. Okay, so that's that. Roughly the same size as the XYLD Fund, which sells them monthly. Okay, so that's what they're going to do. So this will come on today. Typically, it comes on around 2:30, 3 o'clock, between there somewhere. I've seen it come on a little earlier than 2:30. I've seen it come on closer to 3. But we don't know what time it comes on today because it's coming on Black Friday. So we don't know when to expect it. Okay, what to expect when you're expecting. For those of you who know, that was a quick allusion to a book. When you were kids, when you had babies, you read what to expect when expecting, and you're like, oh, the baby kicked, it didn't kick, what's going to happen? So what typically happens, what happens, this happens all at once. It's one big ass trade. They buy this, or they're basically putting on a collar, let's buy and sell, whatever. They put this trade on, and simultaneously, whatever negative deltas come in, there's a lot of shit ass bunch of negative deltas. The math ends up that they end up buying, since this ends up being about a 50 delta, minus 50 delta, 52, 51, whatever it is, they end up buying half as many ITM calls that are going to be a 1 delta. And once or twice I've seen them get cute and buy back the one that they sold, but that's not what they have to do, quote unquote. They buy back whatever's like ITM, or 1 delta, so as not to disrupt the market. So that the hedge that goes on is kind of smooth, and so this hedge coming off is smooth. So the 0 DTE coming off is smooth, rather have all this stuff evaporate all at one time. What tends to happen is we often get a little wiggle when it goes on, sometimes down, sometimes down. We get a little wiggle, then it tends to be somewhat supportive. The math says it shouldn't. All the volatility experts and everyone says, no, it shouldn't have any effect. But OG sees it and it does. I wouldn't bet the farm on it, but it tends to. That's all I'm going to say. But the other side of that is, as we get to the end of the day, that effect tends to dissipate a little bit. So it's often a little trading thing for a blip for a while. Then we kind of like settle back in, and we sometimes go down toward the end of the day from wherever we are. We could be up 0.4 and end up being up 0.35. That's just the overall pattern, not a guarantee that I've noticed. Okay, so that's the JP Morgan collar. So we got that going on. Getting back to our trading view. So we have that over here. Getting back to our trading view, we have the 20 DMA down here. If you remember, it was breaking the 20 DMA that accelerated the cascade down when we went down because the trend following hedge funds, the CTAs started selling and dumping. Right now, CTAs don't have to sell. They will be buying, but they won't be buying everything all at once. And there's an argument of if they have to sell no matter what the tape does. Some say yes, some say no. I say I don't know, but there's nothing bad here. Remember, the leverage ETFs, if we're up, are going to be buying. Again, thin tape, there's not going to be a lot they have to do. So maybe the aggregate they're going to have to do for their shares are going to be selling. It's one of those days, so I don't know. I just don't know. So let's look at what's going on top. Because on top, we have the whale once again in the eye of the tiger. Oh, he's up at 40. So let's give the devil his due here. He's up over here. Okay, so read the book and watched the movie. Yeah, you lived in you had the reality TV version, right? Okay, so now let's go back to over here to depth, to options depth. Let's look at the current sit rep. And so right now we're somewhere around 68.20. So we're in this kind of choppy zone that's sort of supportive. If we go down 50, what is it, 60s, 800 would be if this breaks here, 68.10.20, which also should hold, then 6,800 would be where we would go down to. Then we have this support here at 67.80, which also happens to be roughly the low of the day on Wednesday. So unless there's some reason for this whole thing to unwind on Good Friday, not Good Friday, whatever Friday is, Black Friday, that's probably not going to happen, but it could. To the top side. Now let's remember our dynamics again. And I talk about this often on this broadcast because a lot of people are in the weeds of this. Let's pretend, okay, this is market maker positive gamma wins to the right. What that means is customer, in this case, sold calls, market maker bought them. Once the deltas are hedged, now we have to worry about the gamma, the rate of change of delta. They're long this gamma because somebody sold it to them, so they bought it, and so they have to hedge it. Gamma is not directional. It's just it's how much the delta is going to change. And so what happens? Pretend nothing else is here. As we go up toward this big bar, pretend nothing else is here too. We just have one big bar. As we go up, market makers have to sell. As we go down, now they're too short, they have to buy. So you get that mean reverting loop toward that sticky level if everything, kind of, if nothing else happens. However, that's not the situation. Now let's just pretend these puts were here by themselves. These puts would decay, market makers would buy back their shorts. This we would go up to their classic trade into a big options expiration like we're going to have in the end of December, where there's going to be customer long puts down here and short calls up here, standard collar type trades. They're going to provide this kind of action. So if we're over 20 and we stay there, we could bounce around between 20 and 40 and kind of end up right in between there. And we kind of did that on Wednesday. If we go back to the chart in a minute, I'll remind you that there were customer long calls initially up at 68.20, but then they closed them, they rolled them up to around 40, 30, and 40, and we kind of went right up to them. Then toward the end of the day, we started receding from them. Then some trading came on at the end of the day that pulled us back down. Because once we're under this and these decay from a 50 delta to a 40 to a 30, whatever, then all of a sudden they have to sell what they were buying and the movement associated with it accelerates, or we stick to it, but don't go through it. Above us, we have 68.50 round number. So we have, why do we have two? Because some people do 5 wide, some people do 10 wide in his service. So that's what we have going on here at 68, 45, and 50. So if we get through this, then we have more positive gamma up here, 75. And so, we could go up here and get sucked back toward 50. I don't know that we go through this or not today. We might just end up in here. And those are the dynamics that we have going on. Is anybody here? But we have Sherman, Selena, Dan, Danny Mitchell, of course. Okay. I don't know who else is here. And so that's really it. So to reiterate, we have, let's take a look at 31 people on YouTube. All right, not bad. A little less than usual, not bad. What's going on Twitter? Rick, you're my eyes and ears on Twitter. What's going on Twitter? While we're waiting for that intel, what I want to take a look at. Oh, yeah, let's take a look at VIX. There's my boy. He likes my dog. I like my dog too. You see my dog on Twitter. I'll post a picture of him in the snow a little later. Let's take a look at the VIX is wonky. Yeah, everything's going to be wonky. I don't know if it's going to be normal now. Let's take a look. All right, 17.5. Oh, now we have VIX futures trading. I'm going to assume that these are, notice how thin they are. When the bars are on fluid like that, that's low volume. 18.7 to that's about normal finally. Remember, these were trading equal to or lower than these when these were like in the 22s and these were like 21. There was a 2-3 point difference. And I said, the VIX has to come down to this. It's not the other way around. That was like when the fear mongers were like partying, like it was 1999. And that's basically it. So VIX futures kind of look normal. Are we expecting? So like VIX looks like fairly priced going into a holiday thin weekend, whatever, going into weekend in general. VIX or vol or IV, however you want to think of it, tends not to get bid up unless there's something like people are nervous about the next week. So I'm not expecting any big move in VIX. Probably sit here and kind of drift low, lift lower, maybe hit 17. I don't know. Now let's fast forward the dial a little bit. We hit December, and whatever beginning of month flows, pension funds, I don't know who, what, we have some of that stuff coming in, maybe some coming in today. So there's flows, and these flows tend to be buying flows, supportive into December. But we have the FOMC on December 10th with non-farm payrolls strategically placed after the FOMC, I think on December 17th or something like that, right around options expiration, just to make it fun. Now, again, if we turn the clock back 2 weeks ago, everybody was saying the Fed's not going to cut rates, but then we had some data that came out. Now they're saying the Fed's going to cut rates, and nobody knows, but they're probably going to cut. And so how that plays out into next week, just in the volatility space, forget everything else, and forget if they cut or not, is something we'll keep our eye on. Let's see, I'm trying to see what other moving parts there are, just on the flow side of things. Okay, the vol control funds, which ratchet up or down their allocation based on volatility, based on if implied volatility or is greater than or less than realized volatility by whatever their algo is. They're not slated to buy because we keep on having realized volatility greater than implied. We had the downside, now we're having it to the upside. We need a few days. I'm not sure exactly what the formula is. Different people have different formulas of like quote unquote normal 0.5%, up 20 points, down 20 points, up 15, down 15. Yeah, we need to string together some days in a row and to have the large days roll off the sample size, because it's a moving average of whatever, let's just say 20 days, whatever moving average they use. So we need to have those large days roll off the sample size to then have a comparison of realized vol to implied vol that's not blown out by the inaccuracies of using a mean when you have outliers, when you have data that's not normally distributed. Okay, that's that. Is there anything else to say? Is there anything else to say? So how would I trade it? I can't even, we don't even have fake numbers here on the, do we have numbers finally coming in? Yeah. That looks more or less right. So what would I do? I don't know. I already have stuff. Obviously, these numbers are wrong because 5 cents, the spreads are a little wide and wonky. This is stuff I sold once upon a time all the way down there. Here's where the whale is. I didn't get a whale equivalent, but here's where he is. Similar. Okay, 90 cents. So he's doing okay because he got about $1.70 for this. It was 170, I guess turned it into 470, so it shouldn't, I guess, wherever the number is, I guess make it a 4. I know I'm not going to get filled on that. And that way I have it here as a reference point for later. So it would have been, if it would have been 165, you would have seen 465 there. So he could close it out right now and call it a day. 110, whatever, 60 cents. You see how crazy the numbers are moving until this kind of sells itself out. So what would I sell today? Well, remember we talked about 68.70 up there, 28-point expected move from where we are, let's say 20, let's say 30 points, puts us at 50. So I don't want to be at 50. I don't mind being up here at 70 or 75. Yeah, so now we're getting movement on, we got the party started again. Flies, let's go see. A call fly. Let's just pretend that the IC whale is going to survive. Okay? So if we think he's going to survive, we want to sell. Now these numbers make absolutely no sense. We're going to, oh, that's because I have that. No, these numbers make no sense. Okay. We want to sell where it's not going to go. Maybe give it a little extra room. So a 35, 45, 55 would be a nice trade for 90 cents. Maybe try to get less in case we go to 50. That kind of would make sense. On the other hand, OTHO, remember we had that notch. Remember we got this. Where is it? Remember we have this 10. We have a perfect 10 wide fly, or we can look at 20, but we have a nice little 10 wide fly if there's any weakness. Something like that for 15 cents. That's cheap, but that's pretty. Again, the numbers are crazy. 290 to 260. So maybe you want to give it. We want to go like that. I'm not put that in at 15 cents. I'm not going to get it for 15. I'll give them a quarter. Something is invalid. Why? Maybe I had it in at a credit or something. Let me see something. Oh, it's because they're at a credit. You have to do it for a debit. I'm going to put it in at a 20-cent debit. That debit, 20 cents. All right. Now let me get rid of this so I can do an actual trade that I want to do. And I'll put a 5 wide in it as a placeholder. 985. You see, okay, hold on. Go. Strikes. Let's just move the whole thing up. 475 debit. I'll give him the same 20 cents over here for starters. And again, as you know, I don't mind losing 20 bucks, but it's not going to lose. These things are very forgiving. If you're wrong, you can get out usually a break even or even a profit somehow. So that's kind of where we are. Consider 50 sticky, but if we get over 50, then suddenly 40 becomes support, remember? And we have the stuff up here at 70. And we have people going shopping on Cyber, whatever, no, Black Friday. Speaking of Black Friday, everybody, I'll be putting up my Black Friday sale last day. 50% off the premium, whatever. I'm going to be phasing out anything but premium. It's just going to be one level where you get everything. In fact, it's just too much of an administrative pain in the ass to do two different levels. And plus, I don't like to not show stuff to people who are subscribing to a different level. So let everybody see everything. It's the regular price is $99 a month or $9.99, whatever it is, $999 a year, half off, $49 a month, yearly, less than $500, and you get everything, including the mini scalping room, including the Dan's earnings trades, any options trades or flies I come up with. I also like to do covered calls. I also do collars of my own, variations, small, so whatever other stuff that comes down the pike, it's all in there. We have unusual whales bot. Some people use it. I don't really haven't spent the time yet to master it. Dan used it. Other people use it. And so you get all that for $500 a month, $499.99 or $95, whatever. Psychological studies show that people will buy at that price. They'll also buy if you say 20% off versus 80% off. If you tell them the bargain they're getting, they're gonna buy more than if you just tell them only 80% of original price. Nobody cares. You're not gonna get as many buyers as if you say 20% off. Well known ad marketing, organizational industrial psychology research in my graduate program. We took one class, two classes in industrial organizational psychology. That shit was boring. It was interesting. What was boring is because my job as a psychologist would have been to like construct tests and measures and do institutional surveys and all that kind of picky accountancy spreadsheety stuff, which is just not how I operate. So that didn't interest me from a professional point of view. But it's kind of cool, just like learning how it works in theory. Okay, so here's our zones. Here's where that doesn't look right. The coloring looks wrong. Well, the 20 because we're at the money there, and we have the. That doesn't look right to me. That doesn't look right to me. Sorry. Okay, well, they insist it is, so maybe it is. I don't know. Let me see. Okay. Oh, I'm looking at the wrong spot. I'm looking all the way up there. My bad. So we're over here. Here's the IC whale. Why is there more red than blue? Because we have the double strike up here at 45 and 50. So if over, path of least resistance takes us right there. We have that 68.20-ish where we are. Remember what's there. We had that, what's there, 20? There's going to be a quiz later. What happened here? What happened? Oh, somehow defaulted to funky numbers. Let's go 69.05. And let's go 67.10. Let's go 66.95 just so we see the round number, even though it's basically not relevant. We're going above this round number here. Why isn't it letting me apply? That's weird. Okay, good enough. All right, so we have sellers down here. Okay. And so why do we have that over there? Because we have this 2010 supportive structure. So I mean, you could get a 10, even a 20. You could get a pullback here. Hard to say. Anyway, that's basically it. Let me stop screen share for a second. Let me get my propaganda out. If I can find it. Oh, and I took some stuff that I had written up and organized it and polished it up into some kind of a Gamma course, like a 22-page course. Gamma, according to Doc. I mean, there's obviously some things that are just the facts, but I'm not sure I'm going to do with it yet, but it's there. Maybe I'll do webinars with my subscribers. Maybe I'll do it in public. Maybe I'll do coaching with it. Maybe I'll do all the above, none of the above. Maybe it'll just sit on my hard drive like 10 million other things that I've got written up that are just kind of sitting there. I'm not sure. But it actually came out really good, so I guess I need somebody to push me on the admin part. Okay, so there's the link to I guess put it in on. I guess put it in on Twitter. That's so YouTube doesn't feel slighted. I'll put it in on YouTube. And that's that. Okay, let's pull this back up. Let's just see where we are before I say bye-bye. I wouldn't want to be him. That's all I could say. He's probably okay. Oh, wait. I'm always waiting. One last thing. RUT. Now, he got skewered 3 times, I think, in the SPX, but he got skewered 6 times in the RUT. And people got confused on what strike to sell. So there's this whole mess over here. So 2,500 and higher, we have a whale mess on the RUT. And on the bottom, although it looks like the bottom wasn't as messy, they just got confused on the top. Does that look right? Oh, here they are. Now the bottom we have 64.85. And so, I don't know, if I wanted to look for fun, I might, let's see what that gives me. Oh, I could even go a little lower if I wanted cheaply. You do something like that, but 58 you're not going to get. Well, actually, let's do them both. Now we'll round out the numbers. Something like that, about $1.03. That's not bad. Actually, I'll try to get $1.50 and then maybe play with it later. My point is, there's an RUT trade that I'm willing to do because of all that big stuff. Also know if you do the RUT that it's pretty illiquid. It's hard to get in. It's hard to get out. You have to settle for a shitty fill and sit through it, or if you want to buy it back, you put it at a price and maybe you'll get filled, or maybe you have to pay to get out. Yeah, spreads are kind of normal RUT because we have price discovery of 8 and 8, 16. We have 16,000 contracts-ish price discovery that's usually not there, versus over here we have 14 to 17 bid ask because there's no price discovery there. So yeah, I mean, the fact that he's there makes it more tradable for us. Absolutely, Sherman. Good observation. Okay, so it's now 6:19. So once again, I've overstayed my welcome. Trade safe. Have a happy holiday. Go spend money at Walmart and Amazon because I own stock in both. Yeah, it's pretty illiquid. What? Yeah, it's very illiquid. The only thing that's giving it any liquidity at all is the IC whale decided to start hanging out there, and he was doing some NDXs also. Let's see if we see any whale. No, we don't see any whale prints on NDX. No, he's not there. Okay, so that's it. See everybody, and I'll be putting stuff out on Twitter and on Substack and in my Discord, etc., over the weekend. And keep your eyes open for a picture of the dog and the goats in the snow. See you guys in the trading room. Good luck, everybody.